Good afternoon. Welcome back to Moneycontrol's live stream. You're watching Closing Bell with me, Lavisha Darad, and my colleague Yatin Mota. Another day of sell-off, and what a big sell-off coming in for the markets. We've entered the budget week, and it's a monthly expiry week as well, and we will be watching out on the unfolding of Trump's tariff policies as well. But for today, the Sensex did dive below that 800 points and below 75, 300, 350 odd levels as well. Nifty was also down by 250 points, and it is below that 23,000 odd levels as well. Mid-cap and small-cap indices, that took a major beating because we saw the small caps feeling the major pain and dropped about 4% in today's trading session. India Wix, the volatility gauge, that jumped by 8% and settled above that 17 odd levels as well. If you look at some of the sectoral indices, Nifty IT index, after 3 weeks of straight winning streak, it has fallen by about 4% in today's trading session as well. So all in all, quite a pain point for the markets in today's trading session. Yet then, a lackluster Q3 earnings season, and now a big event coming up, that is your budget on February 1st. Looks like we are headed off to quite a volatile week.
Absolutely, and typically just before the budget, we have seen one of the highest volatilities in the past few years. Today, if you look at the advance decline ratio, which really caught everybody's attention, is almost 1:12. So one stock advancing, and we have 12 stocks falling. Both the mid cap and small cap indices are having a bloodbath today. The mid cap index fell by nearly 3%, 4% down for the small cap index. So overall, I think the breadth of the market has collapsed. Despite a 1% cut on the benchmark indices like Nifty and Sensex, we have the mid cap and small cap which are clearly facing the brunt. And as you rightly mentioned, we have the expiry week. FIs continue to remain seller. We also have the budget event on Saturday. So a lot of events, and then obviously in February we have the RBI meeting when it comes to local issues. Global markets also continue to remain volatile. So let's see what the markets have in store for the next 1 week. It's surely going to remain volatile with the kind of sell-off that we have seen. Markets are probably digesting that Q3 numbers as well.
That's right. But let's get to some of the top Nifty 50 gainers and losers at this point. Well, the ICICI Bank featuring among and standing tall in the Nifty 50 leaders list, up about 1.5% after it posted good set of Q3 numbers, and brokerages also remain largely positive on the private sector lender. Apart from that, we can see some of the FMCG stocks that have also taken up, and it is buzzing in the trade ahead of budget unveiling. Britannia, Britannia, HUL up about 1% each as well. M&M also doing well, up about 1%. SBI, Maruti Suzuki also seeing gains of about nearly 0.5% as well. On the other hand, IT stocks, that was one of the major pain point, and of course they have taken a beating, and we can see the likes of HCL Tech Mahindra, Wipro seeing a cut of about 4% in today's trading session. Shriram Finance also saw a cut of about 3% in today's trading session. And apart from that, we can see Hindalco, Power Grid seeing a cut of 3%. Tata Motors, Infosys also seeing a cut of about 2% each as well. Yatin, why don't you take us quickly through the what went on in the broader markets and what the top gainers and losers were?
Yeah, so if you look at the result reactions, we had Laurus Laboratories, which clearly was one of the top F&O losers. Stock was down 13% despite the management clarification, no respite in the stock. Stocks like CDSL posed a number down 11%, and capital market stocks like CAMS, BSE also were down nearly 7% each. IDFC First Bank down 9% post numbers, Manappuram down 6%, Granules, Idea Cellular, a whole host of the F&O stocks are witnessing a huge amount of volatility. And clearly, a handful of gainers in the F&O segment, the like Bank of India, Torrent Pharma, as well as DLFO's numbers doing well. ICICI Bank also one of the top F&O gainers. So, with the limited stock gainers, we have a huge volatility in the F&O segment with a lot of result reactions, especially on the downside, witnessing a fall of more than 10% plus.
That's right. But without much further ado, let's get on board with our big market voice, Sunil Subramaniam. Sunil, good afternoon. So good to have you.
Good. Nice to speak to you all.
Sunil, we are already in the oversold territory, and quite a heavy week is also lined up for us. Does it seem budget is going to bring much awaited relief for the markets?
Well, that's the hope. But Honestly, this time the budget also, you see, historically budgets have been very capital focused. I'm not sure that this time budget is going to be that, because the problem in the Indian economy is consumption. So I would expect the budget to address the consumption piece. Now, when you address it as consumption and revenue expenditure, obviously the fiscal deficit is a key part to remain. So the balancing act for the budget, I think, is the key thing to watch for this time. And that's why you're not seeing a pre-budget rally. Otherwise, every time you try to see a pre-budget rally, because you'll expect government to announce reforms and capex and promote it. But the fact of the matter is, last year's capex estimates, so what the government thought they will spend, they are nowhere close to spending. So a lot of uncertainty this time surrounding the budget, and I think to some extent a consumption boost can be expected. And so to that extent, I think the consumption related stocks perhaps would not fall as much as the other cyclical stocks in this round.
All
Right.
that's
Sunil
right.
sir, Yatin also joining in from the Mumbai studios. When you talk about private consumption that has slowed, Q3 result season has been a dampener so far. With capex falling short, exports not picking up. What is the saving phase of the markets? You have been a veteran observing market cycles. Do you think we are in a bear market now, or probably it's too early to call this market a bear market?
No, I wouldn't call it a bear market. I would still call it a steep correction in a bull market. And the reason for that is, see, there is still plenty of liquidity within domestic fund managers, which is yet to be deployed. In fact, in today's market moves, if you take, and over the last few days, mid and small caps have corrected much more than large caps. Now, it's true that FII is selling, I think, about 65,000, 66,000 till yesterday. Today's number would probably take it above 70,000. Now, FIIs are selling largely in the large cap space, but the fall is not that much because domestic fund managers are using their liquidity to buy some of those large caps. But they're also creating more cash to buy by booking profit in the mid and small cap. See, mid cap index is today trading at a 50% premium to large cap, right? And the small cap is even richer. So I think there are a lot of stocks there which are run up a lot. And domestic, I saw a data which said as of last month end, there was something like, not last month end, last weekend, there was about 2 lakh crore of liquidity just with mutual funds. To this, you got to add the PMS and the AIFs and other institutional participants. So I believe there is significant cash sitting. The problem with that cash in getting it deployed is the uncertainty, especially the India-related uncertainty, because this is domestic money. Now, while FIs are probably selling a part of India because of the US situation, I think there is more selling in India happening than in other emerging economies right now. And this lack of buying support can reverse very easily. That's why I don't say that we are in a bad market. In a bad market, liquidity will be drying up. But I see that domestic institutions have a lot of liquidity. The events, like there will be an economic survey which comes out a couple of days before the budget. There will be the budget, and then there's the RBI policy. So these three events, plus the fact, as you mentioned, it's a very uneventful earnings season. Now, the worry with that earnings season is that last time, if you recollect, when the September quarter results came out, the earnings season were not great, and then followed the GDP number, which was a shocker at 5.4. Now, RBI governor said that he expects next quarter to go up to 6.8. But the current quarterly season is not giving a confidence that you will be able to reach a 6.8 when the GDP numbers actually come out. So then the country is clearly slowing down, and consumption is the main reason for that. So to that extent, valuation correction has to happen, part of which has happened. But domestic fund managers, I feel, will step in post these three uncertainties, because by February 7th, a lot of the earnings results also will be out. There'll be clarity about the year forward, and that money will come back. And I do expect the market to rally a bit post the RBI policy this year. So I don't see this, just to repeat, as a bear market, but a steep correction in the bull market that we are.
Okay. Sunil, like you mentioned that, emerging markets like India is seeing a lot of selling pressure. So do you believe that so far since October, we are seeing that, there's a tug of war between FIIs and DIIs as well. So for a meaningful recovery to take place in the markets, as you said that, after RBI's rate cut or anything or policy rate decision, we could see some recovery in the markets. How much of your recovery are you penciling in at this point of time? And do you expect that till, like if FIIs stay aloof from the Indian markets, can DIIs offset the majority of the selling pressure?
I don't think, to answer your last part first, I don't think DII's consistent FIIs selling can be of much larger quantity than DII buying capacity. So right now, for the next month or two, I think whatever FIs sell, they can absorb. But if it sustains for longer than a month or two, then it will be very hard for DIS to meet the FI selling pressure. That being said, I don't expect that to happen. So I think that the key is that I expect the large caps to recover much ahead of the mid and small cap, though the correction has happened more in mid and small cap. The reason why I say this is that I see that once this uncertainty goes, for example, RBI policy, if the slowdown is as predicted, right, this quarter's number also come in, I think RBI is poised for a rate cut. Now, if a rate cut happens, financials should rally. Rate sensitives like real estate, auto should rally. So I believe that the large and mid spaces will read, because that's where the valuations will look attractive and the rate cut scenario, liquidity scenario would support them. So I'm seeing a very polarized. I think the cyclical sectors, the smaller caps will take time to come back on track, right? So to that extent, for the rest of this year, I think we should be very careful about what our expectations. This is a year for buying, not a year for selling or booking profits for retail investors. I would say moderate double-digit return from the large cap space, which is probably what is likely for the rest of the year. Middle small caps, I think we'll have to wait unless future earnings seasons come back strongly. It's going to take some time to recover in this phase.
Right, sir. And as you mentioned that there are hopes of RBI rate cuts and probably to support growth and to probably bolster liquidity. Most probably in the upcoming meeting, RBI will cut rates. But that apart, on the government side, nothing much is expected on the budget because the FM has been quite tight-roped when it comes to fiscal deficit management. This year, probably they would meet the fiscal deficit target. Next year, probably 4.5%. Is something the range that brokers are pointing out. 4.4, 4.5 is one of the average ranges when probably we could see that fiscal deficit number spelled out by the finance minister on the budget day. What leeway does the government right now has to boost private consumption to make capex happen? Because last year big bang announcements were made, but when it comes to the ground situation, things haven't really picked up. So will you be hopeful that Q4 will see a big capex pickup? Probably, FY26 as the rate cut happens, we could see some major pickup in overall spending as well.
See, I think that this time the government's focus will be less on capex and more on revenue, expenditure, and consumption. I do believe that they could tinker with the tax to that extent. They could, raise the minimum tax limit to put more money in the hands of the middle class. See, the problem the country is facing is the urban slowdown. See, rural, because of the monsoon, there was a recovery, but urban sharply slowed down. And the two main factors for that are, one are inflation, and second is a sharp polarization in the the GDP per capita. So I think that a lot of the rich people are getting richer, and so high-end products are getting sold, but mass products are not being sold because the inflation and interest rates are hurting. So while the RBI rate cut would help, I think the inflation is still not something that a budget can address. So they have to create some money in the bottom of the pyramid. So I believe that the fiscal room for that will come from two places. They will moderate the growth of capex. There will be a capex growth, but remember that last year's 11 lakh crores promise, they're probably not going to be able to fulfill. So let's say they come out with a 9 lakh crore actual revised estimate for capex, they will take it back to 11 or 12 in the next year. That's one place where by controlling the growth in the capex budget over budget, they will create some room for consumption. The second aspect is, see, tax collections have been very buoyant. Last year in the budget, they had forecast only a 10% to 11% growth in nominal GDP. This year, if they can forecast for next year a 12% or a 12.5% growth in nominal GDP, that creates the fiscal room to spend a little more on revenue. So I think just smart management of the expectations can lead to enough fiscal room. So I don't think the fiscal deficit is at a threat. The government will stick to its path of consolidation, no issues. But reallocation from the capex pool to the revenue pool is probably going to happen. Second is, even in the choice of capex, that capex which filters down to the bottom, right, in terms of the spend, right, rather than go into airports and ports and those kind of things which doesn't filter to the mass, they would probably look at irrigation, sanitation, stuff which reaches the common man as a type of capex they do. So I think there's enough to play with in the budget, and I'm looking forward to the finance minister out a kind of a Houdini or rabbit out of the hat in keeping rating agencies at bay on the fiscal deficit side, keeping FIIs at bay by promising getting a reasonable amount of capital growth, but largely addressing the slowdown in the economy by allocating money to revenue expenditure and developmental capex, which gets to the bottom of the pyramid. So I think it's a very interesting budget to look forward to, and I think the finance minister can pull it off. If that happens, then I think that will be a trigger for a rally in the market, followed by, of course, an RBI policy rate cut.
That's right. Apart from consumption that you were talking about, what other sectors are you eyeing for? Given that you said that, we could be, this is the right time to buy. So what can we expect?
The threat of a tariff on Indian products is one, but the higher tariffs on China means that much more sectors could be open up for foreign participation for the China plus one to get implemented properly. So the government probably needs to give a little more incentives and broaden and deepen the PLI scheme to welcome this. Especially American corporations directly coming, MNCs coming and setting up shop here and re-exporting back to America. Because Trump will probably look more kindly if an American MNC is actually manufacturing in India and taking it back. It means ultimately American business and some amount of work and job creation will happen in US also. So I think India should play that well, and I think that's a key focus of the budget, how the PLI is used well. Second is, India's biggest problem is employment generation. And I think while government construction, capex leads to construction, that's a temporary labor. So I think boosting private sector labor-oriented, again the PLI scheme, if they can provide an additional incentive where a private sector goes into a labor-intensive sector, they could differentiate it and create those jobs, because then there'll be the trickle down, immediately the bottom of the pyramid, the money will flow down. So I think PLI, the way they manage it in this budget, I think could be a key signal for me. The second aspect is, again, in terms of skilling. When you talk about labor, I think one of the key aspects for India reserving China is the productivity difference between China and India. So to that extent, they have to make that up. I think a lot of focus on the skilling of the India's youth. I think a big allocation to that so that we come up to speed quickly and are able to then match China at least part of the way in terms of the quality of the products being exported into the US. So I think Trump, in a kind of overhang, will play its part in the budget, because so far there's been no negative anti-India news coming from the Trump administration. In fact, the External Affairs Minister spoke very positively of where he was seated, how he was treated. So I think India is gearing up to favorably dealing with America. And I think if the budget can make a small step towards that, that will go a long way. I think that's an important focus which I would like to see, because there is opportunities in the whole Trumponomics sphere on what's happening. Because China, his focus is on China, Mexico, and Canada, right? That's where his main thought process is. So India can manage diplomatically better and extract some value out of the whole Trump MAGA factor. That will be good. So I would keenly look forward to whether the FM is able to do something on that front.
Okay, so India is going to benefit from the Trump MAGA factor that you pointed out. But on that note, we have to let you go, Sunil. Thank you so much for your time and giving your insights, and hope that we connect with you soon.
Sure. Thank you. Take care. All the best.
All right. With that, we have come to an end of this edition of the Closing Bell. Thank you so much for your time. Wrapping up, Yatin and me.